Okay, we'll start with valuation under GST. So kindly take that. So now we are going to discuss segment 8, value of supply, which is page number 76. In this valuation, we have only one section, that is section 15, which deals with value of supply, and then we have some rules, that is starting from rule 27 to rule 35. And look into section 15 subsection 1. It is a simple section, intermediate portion, assessable value equals to transaction value. And what is transaction value? The price involved in the transaction, provided two conditions are satisfied. What are the two conditions? Price must be the sole consideration, supplier and recipient are not related. If any one condition fails, then assessable value will not be equal to transaction value, and we need to determine the value as per rules. And there are few inclusions as per section 15 subsection 2. In that 15(2)(a) says all taxes, duties and cess by whatever name called other than GST should be included in the value. So supplier is making supply of goods or services to the recipient, for which recipient will make the payment, and this payment is the transaction value. Taxes, duties and cess by whatever name called other than GST, if charged by supplier to recipient, then only it should be included in the value. For example, municipal tax or property tax, which is paid by the property owner but not recovered from the tenant, it will not be included in the value. Only when it is recovered from the tenant, it will be included in the value. Then next 15(2)(b), recipient is incurring some expenditure, and this expenditure is incurred by recipient on behalf of the supplier. That expenditure should be included in the value because it is actually supplier's expenditure. Any amount that the supplier is liable to pay but which is paid by the recipient, that should be added to the value. And if the recipient is incurring the expenditure on his own account, such expenditure shall be excluded from the value, it will not be included. For example, if the transportation cost is to be incurred by recipient for taking the goods from the showroom to the customer place, then that transportation cost is not to be incurred by the supplier, it is to be incurred anyhow by the recipient, and recipient has incurred it, so it will not be included in the value. Suppose if the supplier is required to make payment to the raw material supplier and that payment is made by the recipient, it's an indirect payment made to the supplier only because supplier liability met by the recipient, so that should be added. That is 15(2)(b). Then 15(2)(c) is about expenditure incurred by the supplier and recovered from the recipient, but in this regard we need to compare with rule 33. Rule 33 says that if such expenditure is incurred by the supplier as a pure agent of the recipient, then it will not be included in the value. So therefore first it should be liability of the recipient which is incurred by the supplier, and the supplier should be acting as a pure agent, then it will not be included. So for example, if there is a chartered accountant who is providing income tax return filing services and wherein the income tax of the client is also paid by the chartered accountant, this actually income tax liabilities of the client, means recipient. Who incurred it? Supplier. Chartered accountant has incurred and in turn recovered from the recipient, so that will not be included in the value. But only thing, they should be acting as a pure agent. When they will be called as a pure agent, certain conditions are there, then only they will be called as pure agent. So supplier incurs the expenditure and recover from recipient. Suppose if it is as a pure agent, that is on behalf of recipient, such expenditure shall be excluded from value. Suppose if it is in the course of supplying, that is for the purpose of providing the supply of goods or services, such expenditure should be included in the value as per 15(2)(c). Then 15(2)(d) talks about interest, late fee or penalty for delay in receipt of consideration, and this interest, late fee, penalty for delay in receipt of consideration not on account of loans or advances. If there is any interest on account of loans, advance, deposits, what is the treatment of that interest? It will be exempted. So if there is any delay in receipt of consideration, for that if interest is collected, that will be included in the value as per 15(2)(d). Then as per 15(2)(e), subsidy is received by the supplier, and we need to check whether that subsidy is directly linked to the price or not directly linked to the price. If the subsidy is directly linked to the price, which means that the subsidy is based on the outward supply. So wherein suppose if the subsidy is given for every vehicle sold, or subsidy is given with respect to every machinery sold, or subsidy is given with respect to every service rendered. So for example, a coaching center is providing services to the coaching services to the students or below poverty line for which one NGO is giving 2000 rupees per student as a subsidy, this is related to their outward supply. So that is directly linked to the price, that is subsidy based on outward supply. Subsidy not directly linked to the price means subsidy will be received irrespective of the like outward supply. For example, subsidy received for setting up a power plant in the backward region, or setting up a factory in the backward region, or subsidy received for setting up a green energy plant, or subsidy for empowering the women, all these things are general subsidy, nowhere related to outward supply. It is ignored and it will not be considered in the value, and it will be treated like donations. So it is treated like either conditional donation or unconditional donation, like that should be the treatment. Whereas directly linked to the price, if it is from central government or state government, that is to be excluded from value. If it is from others, that will be included in the value. Now there are two assumptions that are possible usually. The given price may be after considering subsidy, or the given price may be without considering the subsidy. For example, you can see here, say price charged, price of a product is 10,000 rupees, price of a product is 10,000 rupees. Subsidy from state government is 2000, and subsidy from NGO is say 3000. Now what should be the treatment in this case? That is, price of a product is 10,000, subsidy from state government 2000, subsidy from NGO is 3000. What is the value of supply? Now there are two views which are possible. View 1, whether the given price is after considering subsidy. So price after considering subsidy, price after considering subsidy means that so the given price, let the given price be X. From that X we reduced 5000, so that's where we got 10,000. That is the meaning of this statement. Okay, so there is some given price, we don't know what is that price, from that we reduced this 5000, so that's where we got 10,000. That is the meaning of price after considering subsidy. Suppose if the price is without considering subsidy, if the price is without considering subsidy, so what does it mean? It means that X, the original price itself, will be 10,000 and we have not reduced any subsidy. Now in this case what we need to do is that first we need to start with the price. So what is the price? Here we will take 10,000 rupees. Now here also 10,000 rupees. The first subsidy is subsidy from state government. Subsidy from state government, as per provision, if you see, it is to be included in the value or to be excluded from value. So both this subsidy is directly linked to price, So due to that reason, like this is to be excluded, but in the given price it is already excluded, so ignore. And suppose if it is subsidy from NGO, as per provision it is to be included, in the given price it is excluded, so therefore we need to add. So when you add this, you will be getting 13,000 as the value of supply, 13,000 as value of supply. Then another view also possible, the price without considering the subsidy, which means I have not yet reduced the subsidy. Subsidy from state government is to be excluded, and in the given price it is not excluded, so therefore we need to deduct 2000. Subsidy from NGO to be included, in the given price it is already included, so we will not do anything with respect to that. So 8,000 will be taken as the value. So which view should be taken? So for the exam purpose, when the question is silent, please follow view 1, that is, price should be assumed to be after considering subsidy. This is one way of understanding. There is another way of understanding that is simple. From the recipient, how much is collected, from state government how much is collected, from NGO how much is collected. From the recipient how much is collected, say out of this 10,000, so 2,000 rupees, 3,000 rupees is received from state government NGO, then from recipient we are collecting 5,000, and from state government we are collecting 2,000, and from NGO we are collecting 3,000. So definitely this should be taken as transaction value. So 5,000 and 2,000 will not be coming, 3,000 will be coming, so therefore the value will be taken as 5,000 plus 3,000 8,000 will be taken as the value. Is that clear? So you see how much is received from recipient, how much is from state government, how much is from NGO. Based on that also you can construct this. Suppose from the recipient we are receiving 10,000, from state government we are receiving 2,000, from NGO we are receiving 3,000. Then whatever we receive from recipient is transaction value, from state government will not come and this will come. So therefore the value will be taken as 13,000. Is it clear? So this way also easily you can follow and you can arrive at the answer. Got it? So that is, you just divide as to from whom we are receiving. Accordingly you will know how much should be taken as the value from each and every person. But this is like when we have lot of transactions in the question, you can either follow this way or this way. Both are alternative ways only. And the first one is price after considering subsidy or without considering subsidy. The first one is price after considering subsidy. Price after considering subsidy. And the second one is price without considering subsidy. Price without considering subsidy means subsidy is not reduced. Okay, subsidy is not reduced from the given price. That is the meaning of this statement. Okay, next. So that is what I have given. In the next page you can see, if the question is silent, consider the given price as after reducing the subsidy amount given in the question, that is original price minus subsidy will be taken as the given price. Then in this regard there are two clarifications. Clarification number one, whether the incentive paid by Ministry of Electronics and Information Technology for the purpose of promoting RuPay card transactions or UPI transactions. So generally whenever we are accepting RuPay cards or UPI transactions, in that case there will be acquiring bank. So even every transaction there will be acquiring bank. That acquiring bank will do the settlement. For example, you are coming to our office and you are scanning and you are making the payment. In that case, the moment when you scan and make the payment, you will be making payment from your bank account and we will be receiving it into our bank account. So there is one intermediary here called as acquiring bank. What that acquiring bank will usually do is that they will be collecting the processing fees. But in case of UPI transactions or RuPay debit card transactions, they will not be collecting the processing fees, or they will be collecting very nominal processing fees because they get an incentive from Ministry of Information Technology and Electronics. Whether this incentive which is received by them should be treated as subsidy, yes, that's what the CBSE circular says. Usually such incentive is provided if the amount in the transaction is up to 2,000. It is considered in the nature of subsidy by central government, therefore it is not included in the value and consequently GST is not payable. So because it is on par with subsidy from central government or state government, that's why GST not payable on the incentive received from Ministry of Electronics and Information Technology. Second point, whether the incentive amount received from Ministry of Information Technology in turn shared by the acquiring bank with other stakeholders in the digital payment ecosystem. In the digital payment ecosystem, we have lot of people. So it's not just the acquiring bank, it will be this voice box providers like Paytm, Pine Labs, etc. These devices providers will be there, not they. Then merchant onboarding agencies will be there. Like that, lot of people will be involved in this UPI ecosystem. But whether all the people will be getting the incentive? No, only acquiring banks will get the incentive from Ministry of Information Technology and Electronics. In turn, they will be sharing it with others. But whether the others who are receiving this incentive further from acquiring bank should also treat it like subsidy? Yes, that's what CBSE clarification has given. Sharing of incentive, first acquiring bank received it, thereafter they will share it with other people. Sharing of incentive by acquiring bank with various stakeholders in the digital payment ecosystem. Example, Paytm, Pine Labs, merchant onboarding agencies, as approved by NPCI. So NPCI is the authority which will control all these people. So NPCI should approve that they are part of the digital payment ecosystem. If they are approved, then only the money received by them is also considered. Actually, it is not subsidy from central government, but it is deemed to be subsidy from central government, and that will not be included in the value. So that is with respect to this. So you can see one question. Based on this, I have made questions on amendments. So you can see this. HDFC Bank, question number 14. If you have solved workbook, you see, or questions on amendments, it is there in my YouTube website in downloads. HDFC Bank, an acquiring bank registered under GST, participate in the incentive scheme for the promotion of RuPay debit cards and low value UPI transactions as a scheme run by Ministry of Electronics and Information Technology. Under this scheme, HDFC Bank receives an incentive of 10 lakhs. What is the treatment of this 10 lakhs? As per CBIC circular, that 10 lakhs will be treated as subsidy from central government, therefore it is not treated as value, not treated as value for payment of GST, it is excluded from the value. And as per NPCI guidelines, HDFC Bank is required to share a portion of this incentive with its ecosystem partners involved in facilitating digital payments. HDFC Bank distributes the incentive to stakeholders like Paytm Payments Bank and Pine Labs, which help to facilitate UPI infrastructure. In addition to the compliance sharing, HDFC Bank also shares 2 lakhs with XYZ Marketing Limited, a marketing consultancy that is not part of NPCI specified ecosystem. So therefore, this 4 lakhs which is retained by HDFC Bank, anyhow 10 lakhs collected by them is excluded from the value, that is not treated as like value because it is subsidy from central government. Even 3 lakhs received by Paytm and 3 lakhs received by Pine Labs, these two are also deemed to be subsidy from central government and that will not be included in the value for payment of GST. However, XYZ Marketing is not specified, not part of NPCI specified ecosystem. So whatever 2 lakh rupees received by XYZ Marketing Limited is not deemed to be subsidy from central government. Consequently, it is their consideration on which they need to pay GST. Now answer the following questions based on the facts given above. Is the incentive of 10 lakhs received by HDFC Bank from METI subject to GST? No. Is the sharing of incentive by HDFC with Paytm and Pine Labs taxable under GST? No. Is a further sharing of 2 lakhs with XYZ Marketing which is not compliant with NPCI guidelines taxable under GST? Yes. What is the total taxable value on GST payable if any? 2 lakhs plus 2 lakhs into 18%. So on that GST will be payable. So XYZ Marketing Limited shall pay GST on rupees 2 lakhs. So that is with respect to this, and they will raise invoice to whom? They will raise invoice to HDFC because XYZ Marketing Limited will raise invoice to HDFC Bank. And can HDFC Bank take ITC with respect to that? Yes. So because we don't have any restriction with respect to that, they can definitely take ITC. So that is about this amendment. Then Rule 33. Rule 33 is conditions for pure agent. So that is, as per Rule 33, if the supplier incurs an expenditure on behalf of the recipient as a pure agent, then it should be excluded from the value. But remember, first the supplier is incurring the expenditure on behalf of the recipient, then it should not be included in the value, provided it is as a pure agent. First, when it will be called as pure agent, total 4 conditions should be satisfied. Supplier and recipient, there should be an agreement between them wherein recipient is authorizing through agreement to the supplier to incur the expenditure. Number 2, supplier should recover only the actual amount incurred. Number 3, supplier should not hold the title to the goods or services so procured, and supplier should not use this goods or services so procured for his personal purposes. If these 4 conditions are satisfied, then supplier is a pure agent and it will not be included in the value. But before applying these 4 conditions, prima facie you need to check that it should be liability of the recipient which is incurred by the supplier. Coming back to this example of chartered accountant who is paying the income tax liability of the client. First, is the client making chartered accountant to pay as per the agreement? Yes, there should be an agreement, and whatever income tax that is paid, that much only should be recovered. It should not be income tax of the chartered accountant which is paid and recovered from the client. So it is the client's income tax liability only he should pay, and the income tax receipt should not be in the name of the chartered accountant. That's normal. Then another example, there is a Ola or Uber driver who is transporting the passengers and they have paid the toll charges, and therefore the toll charges is recovered along with the fare from the passenger. Whether the toll charges will come under expenditure incurred as a pure agent. First of all, the liability to incur the toll charges is on the passenger and it is incurred by the supplier, that is Ola or Uber driver. But unfortunately that will not be called as expenditure incurred as a pure agent because the toll receipt will not be in the name of the passenger. The toll receipt will be in the name of the driver or the vehicle. So due to that reason, so supplier should not hold the title, but they hold the title. So therefore they will not get the benefit as a pure agent. Yet another example, that is this real estate agents. Real estate agents will be doing marketing for the purpose of promoting the sale of the real estates. Okay, and this particular real estate agent, for every building sold they will get a commission. plus in addition they will also collect the advertisement charges. Whether that advertisement charges will come under pure agent? No, because first of all advertisement charges is not the liability of the client which is incurred by the real estate agent. For the purpose of providing the service only they are doing it. So therefore we cannot prima facie create a equation for this. We need to check the facts and cases on the question, and depending upon that you need to able to decide. First you need to remember, as per the scope of the work it should be the liability of the recipient. As per the scope of the work of supplier it should be liability of the recipient which is incurred by the supplier. So what are the 4 conditions? Agreement should be there. Number 2, only the actual amount should be recovered. Supplier should not hold the title and it should not be used for the personal purpose. Then there is one circular related to this. Generally airports will be collecting PSF, passenger service fee, and user development fee from the passengers for providing the services to the passengers by way of accessing the airport. And there are a lot of facilities in the airport which the passengers will be using, for which they need to pay, but literally they will not make the payment. Airline will make the payment and in turn recover it from the passengers. Now in this case, whether airlines is acting as a pure agent? Yes. With respect to this passenger service fee and user development fee, airline is acting as a pure agent because it is a liability of the passenger which is paid by the airline to airport and in turn recover it from the passenger. So that will not be included in the ticket fare for computing the GST. But for doing this activity, the airline will get a commission. So that is collection charges they will get. Just because they get a collection charges, does it mean that they are not a pure agent? No. Still they are pure agent because that's an independent activity. Whatever collection charges they get is an independent activity because first they will collect and they will remit, and thereafter they get this collection charges on which they need to pay GST separately. So passenger service fee and user development fee collected by the airline operators from passengers are to be remitted to airport operators and falls under expenditure incurred as a pure agent, and consequently it will not be included in the value even if collection charges is paid for the same by the airport operator to the airline operator. Then next, exclusion from the value. Section 15 subsection 3 we have 3 exclusions. One is discount given before or at the time of supply, that is trade discount. It is always allowed as deduction. Whereas if the discount is given after supply but the terms are agreed before at the time of supply, example cash discount, even then it is allowed as deduction, but here it will not be recorded in the invoice because the discount is given after supply. So therefore for this purpose they need to give one document called as credit note. Who should give credit note to whom? Supplier will give credit note to recipient. In GST always debit note and credit note will be given by supplier to recipient. When there will be debit note, increase in the invoice value debit note, decrease in the invoice value credit note. Because of the discount there will be decrease in the invoice value. Due to that reason a credit note to be given by supplier to recipient. What is the time limit within which the credit note to be given? Remember in 5 cases the time limit will be same, that is 30th November of succeeding financial year or date of filing annual return, whichever is earlier. What are those 5 places? Number 1, time limit for availment of ITC, time limit for issuance of credit note, and time limit for rectification of GSTR 1, time limit for rectification of GSTR 3B, and time limit for rectification of GSTR 8, that is TCS return. In these 5 cases the time limit is common, 30th November of succeeding financial year or date of filing annual return, whichever is earlier. So the credit note needs to be given by supplier to recipient. Whenever the credit note is given by supplier to recipient, what will happen to the supplier liability? The supplier liability will be reduced. And what will happen to the recipient? The recipient has to reverse the ITC, because usually the sale entry will be recipient account debit to sales to GST payable, and thereafter when the credit note is given, so what will happen is that, so there will be debit. For example, discount is given, discount account debit and GST payable account debit to recipient. So GST payable is usually showing a credit balance. The moment when we make a debit, it will be reduction. And what will happen to recipient? As soon as you purchase the goods from me, what is the entry that you will pass? Purchase account debit, ITC account debit to supplier account. When I give you a credit note for discount, this discount is a income for you. So therefore you will make a debit to me, that is supplier account debit to discount received to ITC. ITC usually shows a debit balance. You need to reduce the ITC. But here they have given in the condition that whenever the post supply discount is given and the terms are agreed before at the time of supply, supplier will give a credit note. Based on the credit note, the recipient should reverse the ITC. Then only for supplier the discount will be allowed as deduction. Like that they have added one condition. Say this: the discount is given after supply but the terms are agreed before at the time of supply and allowed as deduction if the credit note is issued and recipient should reverse the proportionate ITC. How do the supplier know whether the recipient reverses the proportionate ITC or not? For that purpose, what is the arrangement that is given? This is not automated in the portal. Till the time it is automated in the portal, they have brought in one provision, that is a latest amendment for May 25 exam. So how to ensure recipient has reversed the proportionate ITC? If the ITC does not exceed 5 lakhs in a financial year, then in that case 5 lakhs of what? That is whatever ITC they need to reverse based on the credit note. Whatever ITC they need to reverse based on the credit note does not exceed 5 lakhs in a year. Supplier shall obtain a certificate or undertaking from the recipient that the recipient will reverse the ITC. Suppose if the ITC exceeds, that is whatever proportionate ITC they need to reverse based on the credit notes given by the supplier in a financial year exceeds 5 lakhs, then supplier shall obtain a certificate from recipient's CA or CMA that the recipient is doing reversal of ITC. When they need to obtain this, is it a prior or a postmortem? Postmortem means after completion of the year we need to get it. Means right now you claim it as a reduction. Whenever you give the credit note, you report it in your GSTR 1, you report it in your GSTR 3B, because of which the supplier liability will be reduced, no doubt about that. But what recipient has to do is that recipient should reverse the ITC. So therefore today we don't know. So you continue doing it. The financial year got over. Against this supplier, so the recipient should reverse the ITC. How much the recipient should reverse ITC against this supplier in a financial year? Means in this year I might have given you 100 credit notes, and cumulative of these 100 credit notes, one supplier, darling, one supplier, not all suppliers, one supplier, all the credit notes ITC component should exceed 5 lakhs. Then you need to get a CA/CMA certificate. Not that one CA/CMA certificate you will get, to whomsoever it may concern, my client has reversed the ITC. Not that. That is of no use. Specific to each and every supplier. You need to get a separate certificate, get a UDIN for that. Okay. So because they are so calculative, they have given this benefit. So each and every certificate means if you have 100 suppliers from whom you got credit notes, then for 100 suppliers we need to give 100 certificates. Is it clear or not? And because they brought in UDIN, otherwise now one copy they will take and they will do Xerox of 100 papers and they will give. Not that. Certificate or undertaking includes details of invoices along with supporting details like GSTR 3B, DRC, how they are reversing the ITC, that detail should be mentioned. Certificate of CA/CMA shall contain UDIN. ITC reversed in a financial year is sum of CGST, SGST, IGST and compensation cess. Means this is the total ITC pertaining to that credit notes. The certificate or undertaking not required to be uploaded in the portal. We don't have to upload in the portal, but whenever department while doing the audit, if they are asking, we need to produce this, but made available to the officer during any proceeding. And this point is a retrospective amendment, which means that even for the prior periods also we need to do this. Means starting from 2017, 18, 18, 19, 19, 20, 20, 21, every year we need to do. So this is like a rainfall gain. Okay. So for the CAs and CMAs, and they have brought in this amendment. And here, if the discount is given after supply, but the terms are not agreed before at the time of supply, is it allowed as deduction? No. Say this. I was into the discussion related to exclusion from supply. Suppose if the discount is given after supply, but the terms are not agreed before at the time of supply, it is not allowed as deduction. That is clear. And so therefore, even if I am giving a discount of 50%, like say at the time of supply I have not agreed, so at a later point of time I am giving a discount of 50%, even though I am receiving 50,000, but I will end up paying GST on 1 lakh. That was the example I was discussing. And here, whether GST is applicable on additional or penal interest on the overdue loan. So basically, interest is divided into two: interest on loans, advances, deposits, or interest on account of delay in receipt of consideration. And in case of hire purchase transaction, the hire vendor only will be giving the financing to the hire purchaser. In that case, the hire vendor will be collecting installments. In each and every installment, there will be interest component, and that interest will be on account of delay in receipt of consideration. So that interest will be taxable. Whereas in hire purchase financing, there will be three parties: hire vendor, financier, and hire purchaser. Now in this case, the hire purchase, like hire vendor will get the money from the financier. The financier will in turn recover money from the hire purchaser. So whatever money that is recovered by the financier from the hire purchaser in installments, that interest will be called as interest on loans, advances, deposits, and that interest will be exempted. So as interest involved in hire purchase is taxable, so penal interest is also taxable, whereas the interest involved in hire purchase financing is exempted, the penal interest is also exempted. There are two transaction options involving EMI that are prevalent in trade. In view of the provisions of the law discussed above, these two options along with the GST applicability are as follows: hire purchase transaction and hire purchase financing. In hire purchase transaction, supplier collects the consideration and in every installment there will be interest, and that interest will be taxable. So as this interest is included in value, penal interest for delay in payment of installment is also included in value. Whereas in hire purchase financing, supplier finances the product and collects the principal and interest as EMI, and this interest is exempted. As this interest is exempted for non-repayment of EMI, there will be penal interest, that penal interest is also exempted. And related to this, credit note point, okay. So credit note point, I have given one question, you can see this question number 13. So that is like right now we have a latest amendment related to that CBSE circular. So connecting that I have given, and online students, those who are watching, hope now it is audible. So you were telling like it is not coming, etc. So please confirm. And say this question number 13. PQR Limited, a manufacturer, entered into contract with DEF Limited, a distributor, on 1st April 2024. The supply was made on 10th May with a value of 25 lakhs and applicable GST rate was 12%. And payment terms required: full payment within 30 days of invoice date. A post supply discount of 7% was agreed upon. Conditional on DEF Limited successfully selling 80% of the goods within the quarter. So if you are selling 80% of the goods within the quarter, you will get a post supply discount of 7%. So definitely it's a post supply discount, and the terms are also agreed before at the time of supply. By 30th June 2024, DEF Limited sold 85% of the goods, making it eligible for the 7% post supply discount. Consequently, on 15 July, PQR Limited issued a credit note for such discount to DEF Limited for post supply discount. DEF Limited had availed the ITC on the full invoice value as they complied with the conditions for availment of ITC. To comply with the provisions of 15(3)(b), DEF Limited is required to reverse the ITC proportionate to post supply discount. Now question number 1, how much ITC needs to be reversed by DEF Limited based on the credit note issued by supplier? So please see what is the value for which discount will be given. So 25 lakhs is the total price. On that, 8% will be the discount. So the 8% or 7%? 7%, that is 1,75,000 is the discount. What is the tax component in the discount? So this 25 lakhs is excluding GST. So therefore that 1,75,000 discount is also excluding GST. On the top of that, into 12%, that is 21,000. So that is the ITC component to be reversed by DEF. So DEF has to reverse an ITC component of 21,000 based on the credit note given by supplier under section 34. What is the consequence to PQR Limited based on that credit note? So for supplier, recipient should reverse the ITC, but for supplier their liability gets reduced. So liability of PQR gets reduced as and when credit note is issued and reported in GSTR 1. Then how PQR Limited can prove that recipient has reversed the ITC? What is the ITC component? Assuming that this is the only transaction in this financial year, what is the ITC component? 21,000, which does not exceed 5 lakhs. So then in that case, the recipient should give a declaration to the supplier that they are going to reverse the ITC. So as per CBSE circular, as ITC reversal in a financial year does not exceed 5 lakhs, PQR Limited shall obtain a declaration from DEF Limited that they have reversed the ITC along with supporting documents, that is GSTR 3B or DRC 3. Okay. Then next, what will be your answer in 3 above? If the ITC to be reversed is 5,50,000 in this financial year, means like this, there are multiple transactions which is happening throughout the year, and for this particular supplier's credit note, they have to reverse an ITC of 5,50,000 as this amount exceeds 5 lakhs. So therefore we need to, that is supplier should get a certificate from DEF Limited CAR CMA certifying that they are reversing the ITC along with UDIN and supporting documents, and this procedure to be followed even for the past periods. So that is with respect to this. Next, so what is the treatment of inclusions or exclusions? So we have seen now 5 inclusions. 15(2)(a), taxes, duties and cess by whatever name called other than GST. 15(2)(b), recipient incurring expenditure on behalf of the supplier. 15 to C, supplier incurring expenditure and charge it to recipient. When it should be charged? Before, at the time of supply, or before the time of supply of goods, or that is delivery of goods or supply of services, it should have been collected. 15 to D, interest, late fee, penalty for delay in receipt of consideration. 15 to E, subsidy directly linked to the price other than from CG or SG. These are the 5 inclusions, and 3 discounts we have seen, and that is exclusion. First, as per provision, you need to see whether the amount to be included or not. If it is to be included, what they have done in the given price, it is already included. So ignore. If an amount is to be excluded and it is already excluded, then also ignore. And if an amount is to be included, but in the given price it is not included, so therefore you need to add. An amount is to be excluded, in the given price not excluded, so that you need to deduct. Then next one, whether no claim bonus given by insurance company. Generally insurance companies, what they will do, suppose last year I have not made any claim with respect to my car insurance. This year when I am renewing the car insurance, I will get a no claim bonus. Say the renewal premium is 8,000 and I will get a no claim bonus of 1,000 rupees. Literally I will pay only 7,000 rupees. Whether this 1,000 rupees can be called as discount, pre-supply discount? Yes, because for renewal premium only they are giving me this discount. Before paying the renewal premium itself, they will be giving me this discount. So it's a pre-supply discount, and accordingly pre-supply discount is allowed as deduction provided it is duly recorded in the invoice. So therefore, while giving me the payment advice, so what they should do is that they should mention 8,000 minus 1,000, 7,000 like that. Then in that case GST will be applicable only on 7,000. But some insurance companies, what they do, they follow a different pattern for no claim bonus. First they will be asking me to pay 8,000, thereafter 1,000 rupees they will be giving me like a cash back. In that case, is it treated as a discount? No, because it is not duly recorded in the invoice. Due to that reason, it is not allowed as deduction. So no claim bonus shall be claimed as deduction as pre-supply discount from the value if the same is shown in the invoice as per section 15 subsection 3. Then next one, we have summary on CGST rules, rule 27 to rule 31 related to valuation. First we need to see if price is not sole consideration. There are 2 conditions. Price must be the sole consideration, supplier and recipient should not be related. And what if price is not sole consideration and supplier and recipient are related? Then we need to apply rule 27 and rule 28. Rule 27 is applicable when price is not sole consideration. Price is not sole consideration means apart from price there is some other consideration which is received. That is, the consideration is there, but the consideration is in non-monetary form, or the consideration is partly monetary and partly non-monetary form. Then rule 27 is applicable, and this rule 27 is common for both goods and services. So we have 5 priorities. First, priority number 1, you see the open market value. Priority number 2, if open market value is not available, money received plus money value of non-monetary consideration. If that is also not available, we need to take like, kind and quality. If that is also not there, we need to take cost plus 10%. So this is the priority. If that is also not available, we need to go by rule 31, where the valuation will be determined by the officer. If the above is not possible, the value shall be determined as per rule 31 by applying the principles of valuation. So this is about the 5 priorities. Why will open market value not available? We need to understand the difference between open market value and LKQ. Open market value will be the day, that particular day between 2 parties, whatever is the price that will be taken. So the comparable time will be same date, and comparable value will be transaction value. Comparable supplier, same supplier or any other supplier. Comparable goods should be same goods. Then only OMV will be coming. Whereas LKQ is not like that. In case of LKQ, the comparable time can be any nearest date. The comparable value, so transaction value or even the value as per rules also can be taken. Comparable supplier, same supplier or any other supplier. So that's an ICA assumption. Then comparable goods, same goods only, but minor differences will be acceptable. So this is about OMV and LKQ. For example, I am an actor and I started acting. So this is my first movie, and in my first movie itself, so I am asking for distribution rights. Plus I will also get a remuneration of some 50 crores. 50 crores plus remuneration plus distribution rights in Andhra Pradesh. Okay. So therefore in this case, is the consideration fully in monetary? No. 50 crores monetary plus distribution rights in Andhra Pradesh is non-monetary consideration. Then definitely value will be as per rule 27. Open market value means today an actor like me, so some other transaction, either myself signed another movie today or an actor like me signed another movie today, what is the remuneration? That will be taken as open market value, which is not that easy to determine. So due to that reason, open market value will fail, because on the same day the transaction may not be available. Then in that case, money received plus money value of non-monetary consideration. What is the money that I have received? 50 crores plus money value of non-monetary consideration, that is the distribution rates ka value. It is very difficult to determine the distribution rates, because this is my first movie, I have already distributed, I have made some earning, that will be taken as a value of the distribution rights. So this is my first movie, so therefore this is not ascertainable. So therefore option 2, that is priority 2, also fails. Priority 3, like kind and quality. Like kind and quality means any nearest date. So this is my first movie, so therefore there is no other movie which I have signed, so due to that reason there is no remuneration received. And all other actors, I know they are like first movie itself, they will not be collecting. So LKQ also it is not available, so there is no comparable transaction. And thereafter cost plus 10%. Cost plus 10% means cost of providing the service plus 10%. So what is my rate? I mean, what is the service rate? What is the service rate? That is very difficult to determine again. So because there is no standardization which is available with respect to actor. For one day if they are acting, how much is their rate for one day? It is very difficult to determine. For that purpose, so cost plus 10% also fails. That's where residual value will come into picture. So this entire energy I spent to tell you that residual value only. So residual value will be ascertained in that way, wherein using the principles of valuation, I need to declare some value as the residual value. Understood? Then, so see the next rule. Next rule is what? Related party transaction, including transaction between distinct persons. Carefully listen, we have 3 rules. Rule 27, 28, 29. 27, price is not the sole consideration. 28, related party transaction, including transaction between distinct persons. 29, that is principal agent transactions. In the first case, we have 5 points, correct? In the second rule, second point is missing. Carefully listen. OMV, money received plus money value of non-monetary consideration. LKQ, cost plus 10%. Rule 31. Okay, residual value. Now what happens? Second rule. In second rule, second point is gone. So we have OMV, thereafter LKQ, thereafter cost plus 10%, and thereafter rule 31. Whereas in the third rule, third point is missing. That is LKQ, first OMV, if not cost plus 10%. LKQ is not there. OMV, if not cost plus 10%, if not residual value. Is it clear? That is this rule 28. And this rule 28 is 28 sub rule 1, transaction between related parties including distinct persons. So please write down rule 28 sub rule 1, and this is also applicable in case of both goods and services. And here OMV should be taken, but I have added one proviso. What is that? If the recipient is eligible for full ITC, open market value equals to deemed to be transaction value, provided the recipient is eligible for full ITC, 100% of the ITC. Means what? The recipient, when he is eligible for full ITC, if his outward supplies is fully taxable, if his outward supplies is partly taxable or partly exempted, he will not be able to take ITC fully. So therefore, if his outward supplies is fully exempted, also he cannot take ITC. Means his outward supply, whose outward supply? My recipient's outward supply fully taxable, then only he can take full ITC. Then OMV is deemed to be the transaction value, that is whatever value that I declare in the invoice, that will be taken as the open market value. What if the recipient is not eligible for full ITC? Then I need to ascertain the open market value. Then if this is not possible, then we need to take like, kind and quality. If that is also not possible, then cost plus 10%, and thereafter finally residual value. Then you can see here alternatively means without following this OMV LKQ cost plus 10%, I can go for resale price method. Resale price method means the price at which my recipient is further selling to an unrelated buyer into 90%. So I am selling to one related person, or I am selling to one distinct persons. Now that related person or distinct person subsequently sells to unrelated buyer into 90% will be taken as my value for payment of GST. It is at the option of the supplier with respect to each invoice they can decide. But this proviso is applicable only in case of goods, not applicable in case of services. Alternatively, in case of goods, highlight that only in case of goods this point will be applicable. At the option of the supplier, for each supply, 90% of the price at which recipient supplies like kind and quality to an unrelated buyer. Recipient should not process those goods but should have been sold it as such. Okay. So therefore, if the recipient is processing and subsequently selling, this point will not be applicable. And next, so third point, that is principal agent transaction. In case of principal agent transactions under 7(1)(c), rule 29 is applicable, but this is applicable only for goods. Rule 27 and 28 is for both goods and services, but rule 29 is only for goods. And even this proviso is also that resale price 90% is also only for goods. And in case of principal agent transaction, either I can go for OMV or 90% of the price at which the like kind and quality is sold to an unrelated buyer at the option of the supplier for each supply. Suppose if this is not available, then they can go for cost plus 10%, if not residual value. And if there is a sole selling agent, sole selling agent is related. Yesterday while discussing related definition, I told you family scope. In that family scope, yes refers to sole selling agent. So sole selling agent always we need to take rule 28, not 29, because rule 29 is a general provision, whereas 28 is a specific provision for related parties. So due to that reason, in case of sole selling agent, we need to apply rule 28. Then you can see here, if the above is not possible, residual value. For rule 30, cost plus 10%, what should be taken as the cost? In case of manufacturer, cost of production. In case of service provider, cost of providing service. And in case of trader, cost of acquisition should be taken. You can see for cost plus 10%, cost shall be cost of production in case of manufacturer, cost of acquisition in case of trader, and cost of providing service in case of service provider. And as open market value equals to transaction value, invoice can be generated for any value. Even 1 rupee can be considered as value for this purpose. And then in case of services, rule 30 can be skipped and proceeded to rule 31, as determining the cost of providing service is difficult. So generally rule 30 is cost plus 10%. We can skip that and go to rule 31. Even if value is determined as per CGST rules, the inclusions and exclusions will be applicable. For example, instead of taking transaction value, you go for open market value. But whether the discount point is applicable even in that case, yes. See, just for transaction value only we take this value as per rules. It does not mean the inclusions and exclusions are not applicable. Those 5 inclusions and that discount exclusion is to be applied here. Then alternative value of 90% on resale price under rule 28 is applicable only in case of goods. And in case of transactions between distinct person and principal and agent, even though transaction value under section 15 is applicable, because transaction value under section 15(1) says that price must be the sole consideration, supplier and recipient should not be related. And if they are distinct persons, whether they are related, no. And if they are principal and agent, they are related, no. Then definitely transaction value can be applied. Even then we need to determine the value as per rule 28 and rule 29 only. Why is it so? Because of section 15 subsection 5, which says that notwithstanding anything contained in 15 subsection 1 and 15 subsection 4 with respect to the notified transactions, we need to determine the value as per rules only because of that reason. So in case of transaction between distinct person and principal and agent, even though transaction value under section 15 is applicable, value shall be determined as per rule 28 and 29 respectively. Then next, how to determine value of supply in case of import of services from a related person where the recipient is eligible for full ITC. So this point is always common. You remember, in wherever it is RCM, so in case of RCM, that is import of services, so we need to pay GST under RCM. And if the recipient is eligible for full ITC, then rule 28 will come. Again, I am repeating carefully, listen. So you are importing services from whom? From a related person. It is supply. Okay, it is supply under either 7(1)(b) or 7(1)(c). Okay. Now in this case, when recipient is eligible for full ITC, first you need to determine value as per rule 28 because it's a related party transaction. As per rule 28, we have one point. If recipient is eligible for full ITC, open market value is nothing but the value declared in the invoice. But as the transaction is coming under RCM, there is no invoice given by the supplier, then in that case what should be taken? So in that case, if there is no invoice given, then we need to take the value as nil. Okay, say this. Value determined as per rule 28. As recipient eligible for full ITC, transaction value deemed to be open market value. As the said transaction is covered under RCM, invoice raised by recipient under 31 subsection 3 clause F. Usually self invoice to be given by recipient to supplier in case of RCM. If invoice is not issued, the value of such services is deemed to be nil. Is it applicable for all the services? Yes. With respect to all the services, it will be applicable. Okay. Then based on this, I have given one question. You can see that question here. Infosys Limited, question number 15, page 656. Question number 15, Infosys Limited, a registered company in India, is engaged in IT consulting and software services. Infosys Consulting Incorporation, its related foreign entity based in USA, provides software development support and consulting services to Infosys Limited in India. Both entities are related person under the GST provisions. In October 2024, Infosys Consulting Incorporation provides software consulting services worth 20 lakhs to Infosys Limited. So definitely it's an import of service from a related person. Since this transaction is an import of service, Infosys Limited is required to pay GST under RCM. Additionally, Infosys Limited is eligible for full ITC on this transaction. So now, moreover, Infosys Consulting Incorporation also provides strategic advisory services to Infosys Limited without issuing any invoice. The domestic entity Infosys Limited estimates the market value of these services to be 5 lakhs, but no official invoice is generated for these services. So, as the recipient is eligible for full ITC, in the first case for 20 lakhs invoice is issued, correct? Invoice is issued, and therefore we will take 20 lakhs as the value, whereas in the second case 5 lakhs, no official invoice is given. As invoice is not issued, it will be taken as nil. And first question, whether Infosys Limited is required to issue any invoice to Infosys Consulting Incorporation. Remember, in case of services or goods covered under RCM, when the supplier is unregistered and the supplier is not giving invoice, the recipient has to give invoice to the supplier under section 31 subsection 3 clause F within 30 days. That is also an amendment. In tax invoice, that's an amendment. The recipient has to give invoice to the supplier within 30 days from the date of receipt of goods or services. See here, as per section 31 3F, Infosys Limited shall issue invoice to Infosys Consulting Incorporation within 30 days from the date of receipt of services. Then second, who is required to pay GST in the present case and what is the value on which GST will be payable? So GST payable by recipient under RCM because it's an import of services. Section 9(3) read with notification 13/2017, GST payable by Infosys under RCM. Then if Infosys Limited, and what is the value? The value will be only 20 lakhs. Why only 20 lakhs? Why this 5 lakhs we cannot take? Because of the CBIC circular. The CBIC circular says if the invoice is not issued, the value shall be taken as nil. And only for 20 lakhs the invoice is being given, so we are taking that. And if Infosys Limited declares 20 lakhs as the value of software consulting services from Infosys Consulting Incorporation in the self invoice, they declared only 20 lakhs. Compute the GST payable by Infosys Limited, only 20 lakhs. Applying the above circular, value of supply shall be invoice value as recipient is eligible for full ITC. If value declared in invoice is 20 lakhs, then GST payable under RCM on 20 lakhs into 18%, 3 lakh 60. What if in the invoice they mention 25 lakhs? Then the 25 lakhs will be taken as the value. Got it? That is the application of this particular circular. Then there is one more rule that is newly added, that is rule 28 sub rule 2. Already previously we had this, but this was given as a second proviso, third proviso, and now they made it as a separate rule, and wherein this is in case of corporate guarantee. Corporate guarantee between related person. One company is giving guarantee to another company with respect to the loan taken by the another company, for which there might be some consideration or there may not be consideration. But what should be taken as the value? Even if there is no consideration, transaction between related parties treated as supply under section 71C. So say this, value of supply in case of corporate guarantee to a related person located in India. Very, very important, located in India. What if the recipient is located outside India? Means a company giving the guarantee and the company receiving the guarantee, if both are in India, definitely this rule will be applicable. Company giving guarantee is outside India, company receiving the guarantee is in India, then also this rule 28 sub rule 2 is applicable. Company giving guarantee in India, company receiving guarantees outside India, then this rule will not be applicable. Then in that case what we need to do? Even that is also related party transaction, yes. So this rule will not come. Then we need to determine the value as per rule 28 sub rule 1. This rule OMV LKQ cost plus 10%, that will be applicable. Okay, so value equals to 1% of the amount of guarantee offered per annum or the actual consideration, whichever is higher should be taken. Previously it was 1% of the guarantee offered or actual consideration, whichever is higher was there, but this per annum they have added now, which means if the tenure is for 4 years, 1% per annum, so into 4 years means 4% will come. Previously standard 1%, now depending upon the tenure of the loan. So if the loan is for 6 years, 6% will come, got it? Or the actual consideration, whichever is higher. Now this point was not there before, now they have added, if the recipient is eligible for full ITC, then whatever value that is declared in invoice is deemed to be the value. Then 1% is computed on the loan sanction but not on the loan disbursed. A very, very important point. For example, if the loan is for 100 crores and a company is giving guarantee for 100 crores, but out of that 100 crores, only 60 crores is taken as loan right now, but sanctioned is 100, disbursed is only 60. Now this 1% will be computed on 100 crores or 60 crores? Only on 100 crores, because on the guarantee given. So therefore compute on the loan sanction but not on the loan disbursed. Recipient can avail ITC with respect to GST paid by supplier irrespective of the loan disbursed. For example, so I am the supplier company or the recipient company, I gave the guarantee for 100 crores but you received only 60 crores of loan. Now whatever GST that I pay, that is 1% on 100 crores or actual consideration, whichever is higher I pay GST and I will raise invoice to you now. Now can you take that ITC? Yes. Even though you received only 60 crores of loan, but you can take ITC with respect to whatever invoice that I am raising to you. If the loan is for a fixed term, then 1% computed for each year and GST payable at the time of issuance of guarantee. However, in case of annual renewal, GST will be payable yearly based on the value determined each year. For example, if the loan is for 4 years, I told you already, 1% into 4 years or actual consideration, whichever is higher. Suppose if the loan will be renewed every year, first year we will pay 1% into actual consideration, whichever is higher. Again second year the loan will be renewed, again second year the loan value may get reduced because the principal will come down now. Throughout the year some EMIs will be paid. Don't sleep here, don't sleep, very, very important. If this attempt, this question is not coming now, next attempt I will quit teaching. Okay, open challenge, 1 crore rupees bet, will you sign? Definitely it will come, definitely it will come, that much strong I am, definitely it will come, otherwise I will quit. Open statement I am giving, it is being recorded also, okay, that much guarantee it will be, because you are all sleeping. Because you are all sleeping, definitely it will come. Whenever we learn something and when we get sleep and all, definitely it is guaranteed in exam. That's what I say for you. So therefore, say this, if it is annual renewal, what will happen? So next year again I will renew. When I am signing next year, first year you fully made the principal payment. So due to that reason, if the loan is for 100 crores, the next year the loan will not be for 100 crores, the loan may be for 90 crores. So depending upon the value of the loan for the next year, we need to compute the guarantee. So 1% of the loan amount. If the loan is for part of a year, say for example, if the loan is for 9 months, then what we need to do? 1% is per annum. So 1% into 9 by 12. 1% into 9 by 12 is considered as value. Then whether GST is applicable on corporate guarantee in case of takeover of loans, since it is merely an assignment of already issued corporate guarantee. For example, so if there is one particular bank, HDFC bank, which has been taken over by ICICI Bank, for example, I am telling you. Now in that case, when the ICICI Bank takes over the HDFC Bank, the loan also will be taken over. When the loan is taken over, ICICI Bank will ask me to sign again. So when I sign again, then GST department will again get money. You understood or not? So takeover of loans by one bank from another without issuance of a fresh corporate guarantee or renewal of corporate guarantee would not tantamount to provision of corporate guarantee service. Therefore, GST is not applicable. Suppose if they ask me to sign the fresh guarantee, definitely GST will be applicable. Mere taking over of loan, there won't be any liability. But a fresh guarantee to be signed, definitely GST liability may arise. Then, where corporate guarantee is provided by more than one entity, what is the amount on which GST payable by each co-guarantor? That is, what will happen? Three companies together may guarantee. Then in that case, normal. You take 1% or actual consideration, whichever is higher, and you apportion that between those three companies in their loan ratio. For example, if 100 crores is the guarantee, A, B, C are three companies, A will tell 40 crores to that extent I will give guarantee, B will tell no 30 crores and C will tell so for 30 crores. Now the total money divided between 4:3:3 ratio. What if we don't have any ratio? It is like joint and several like that. Then in that case equally you need to divide. Okay, say this. If the total consideration paid to the guarantors exceed 1% of such guarantee offered, then value of supply to be actual consideration received by each co-guarantor, and other cases proportionately on 1% of the guarantee offered by each co-guarantor. In the absence of ratio, equal proportion to be taken. Whether intra-group corporate guarantee liable to RCM. Suppose if the supplier foreign company and recipient is an Indian company, then definitely for that guarantee it is coming under RCM. Supplier located outside India and recipient in India, RCM. If both are in India, FCM, and supplier is required to issue invoice. Whether the valuation in terms of Rule 28 sub Rule 2 will apply to the export of service of providing corporate guarantee between related persons? No. Because in case of export of service, where the recipient is located outside India, first of all, this Rule 28 sub Rule 2 is applicable only if the recipient is located in India. If the recipient is located outside India, this is not applicable. So Rule 28 sub Rule 2 shall not apply to the export of service of providing corporate guarantee between related persons. In such case, we need to determine the value as per regular rule. That regular rule is Rule 28 sub Rule 1, that is OMV, LKQ or Rule 30. Okay, so like that we need to determine. Then these provisions whatever we have discussed is in the context of corporate guarantee. Corporate means, remember, only companies. Suppose if partnership firm is giving guarantee, this will not be applicable. It is only for the companies which is giving guarantee. Then there is something called as personal guarantee. Personal guarantee means which is given by the director of the company to the company. Then in that case, whether it will be coming under related party transaction? Yes, because director of a company and the company are treated as related. So it's a related party transaction and the value will be determined as per Rule 28. But the problem is RBI has given one circular that director who is giving guarantee to the company should not collect any consideration from the company. Due to that reason, CBIC gave a clarification that the value shall be taken as nil. In case of personal guarantee by director to a company without consideration is applied under 7(1)(c) and value under Rule 28 shall be considered as nil as per CBIC circular. Why? Because as per RBI circular, consideration should not be paid in case of personal guarantee by a director to a company. However, personal guarantee can be given by ex-director to a company for a consideration. Then it is not a related party transaction and the value will be determined as per section 15. That is about this corporate guarantee and personal guarantee. So please look into one question. So this kind of question may be coined. You can see that page 657, question number 16. XYZ Limited, an Indian company registered under GST, provides corporate guarantee to 4 different entities. ABC Limited, in which XYZ Limited holds 60% equity. Is it related? Yes. For a loan of 10 crores from a bank for a period of 1 year, XYZ Limited does not charge any specific consideration for this service. So what is your answer with respect to this? So 10 crores into 1%. So that will be 10 lakhs. Both are in India. Yes, both are in India. So therefore 10 crores into 1%, 10 lakhs will be taken. There is no actual consideration. Second, PQR Limited, in which XYZ Limited holds 20% equity. Definitely they are not related, because with 20% equity they cannot become related. For a loan of 20 crores from a bank for a period of 2 years, XYZ Limited charges an annual fee of 2 lakhs for providing this guarantee. So it is not a related party transaction, but it's a normal transaction chargeable to GST under 71A section 15, that is 2 lakhs will be taken as a value, and first year 2 lakhs and second year will be 2 lakhs. See the answer. Transaction value under section 15 is 2 lakhs in first year and 2 lakhs in second year based on the invoice issued. Third case, LMN Corporation, a company located in Singapore, who is the largest material supplier of XYZ Limited, for a loan of 15 crores for 1 year. No consideration is charged for this guarantee. First of all, largest material supplier and all is not a related party. So therefore it's not a related party transaction. Consequently, there is no supply here because there is no consideration. First check. So that's what, every time you see a question, you need to check whether it is supply or not a supply. In this case, it is not a supply. Why it is not a supply? There is no consideration, and moreover it is not from a related person. So what are the 4 activities, even though without consideration, constitute supply? DRIP. D for disposal of business asset on which ITC avail. Then related party transaction, including transaction between distinct person, import of service from a related person or other establishment located outside India, principal agent transactions. Okay. Then, so that's why it is not a supply, and GST payable shall not arise. DF Limited is related entity located in UK. So for a loan of 30 crores for a period of 3 years, XYZ Limited charged a consideration of 45 lakhs for providing this guarantee. Rule 28 sub rule 2 is not applicable. Why not applicable? Because where is the recipient located? Where is the recipient located? Outside India. DF Limited is related entity located in UK. So 28 sub rule 2 will not come, but the value will be determined as per 28 sub rule 1. Value under rule 28 sub rule 1 is open market value to be determined. If that is not available, like, kind and quality. If that is not available, cost plus 10%. Okay. Transaction value not applicable, as this corporate guarantee is to a related entity, and rule 28 sub rule 2 also will not be applicable. Why not applicable? Because the recipient is located outside India. Got it? So this is about this, and I have developed some more questions also for the purpose of application of this. Maybe anything can be asked. In second year. Fine, it is not there. Fine, in the break I will open and I will show that. Okay. So, but I have developed some questions. The PDF is missing. Correct. In revised book it is there. Five 514. Okay. Okay, say this. Look into these questions. So compute the value of supply with respect to corporate guarantee with respect to below mentioned situations. Assume that the recipient is eligible for full ITC only if specified in that situation. Case number 1, XYZ Limited issued a corporate guarantee of rupees 20 crore to its related party DF Private Limited in India on November 1, 2023 for a period of 1 year without charging any specific consideration. XYZ Limited charges 50,000 as an actual consideration. DF Private Limited is eligible for full ITC. When the recipient is eligible for full ITC, open market value is deemed to be the transaction value. So due to that reason, this 50,000 will be taken as the value in this case. Case 2, XYZ Limited along with its other related entities, MNO and PQR, jointly provided corporate guarantee to a bank on behalf of GHI Private Limited related for a loan amount of rupees 30 crores. So therefore, they have given the loan. 3 companies together has given the guarantee to their related entity, where XYZ Limited share being 15 lakhs. The total actual consideration paid by GHI Private Limited for this guarantee is 25 lakhs. First, you need to determine the value as per Rule 28 sub Rule 2, that is 30 crores into 1% or 25 lakhs, whichever is higher, that is 30 lakhs. So in this 30 lakhs, so XYZ Limited share is 50%. Out of 30 crores, their share is 50%, which means that 50% of this 30 lakhs, you give it to XYZ Limited. So XYZ Limited will be 30 lakhs into 50%, 15 lakhs. Thereafter, remaining 2 companies, we don't know what is the share. Therefore, we need to equally divide between them. So MNO and PQR, the remaining 15 lakhs divided by 2, so 7 lakh 50 and 7 lakh 50,000. Then case number 3, XYZ Limited along with its other related entities, MNO and PQR, jointly provided corporate guarantee to a bank on behalf of GHI Private Limited related for a loan amount of 30 crores, where the XYZ Limited share being 12 lakhs, the total actual consideration is 35 lakhs. Now in that case, 30 crores into 1%, 35 lakhs, or 30 crores into 1%, 30 lakhs or 35 lakhs, whichever is higher will be 35 lakhs. Now that 35 lakhs, first XYZ Limited share is only 12, so into 12 divided by 30, 14 lakhs. So out of that 35 lakhs, 14 lakhs is gone. What is the remaining amount? That equally divide between MNO and PQR, so 10 lakh 50 and 10 lakh 50,000. Then case number 4, XYZ Limited along with other related entities, MNO and PQR, jointly and severally provided corporate guarantee to a bank on behalf of GHI Private Limited, not related, for a loan amount of 30 crores. The total actual consideration paid by GHI Private Limited for this guarantee is rupees 15 lakhs. As it is not to a related person, so we need to take the actual consideration as the transaction value. Value under section 15 is transaction value, that is rupees 15 lakhs. Rule 28 not applicable. Why it is not applicable? Because it is not a related party transaction. Then whatever is the consideration amount shared by XYZ, MNO and PQR out of such 15 lakhs is considered as the value of supply by them. Then case 5, XYZ Limited's parent company LMN Corporation based in Singapore provided a corporate guarantee to a bank for XYZ Limited in India for a loan of 40 crores for a period of 3 years. Whether Rule 28 sub Rule 2 is applicable? Definitely, because the supplier is outside India and the recipient in India. So if recipient is in India, definitely it will be applicable. Corporate guarantee by related supplier outside India to recipient in India, value under Rule 28 sub Rule 2, that is 40 crores into 1% for a period of 3 years. So into 3, that is 1 crore 20 lakhs, GST payable under RCM. Case 6, XYZ Incorporation parent company LMN Limited based in India provided a corporate guarantee to a bank for XYZ Incorporation in Singapore for a loan of 40 crores for a period of 3 years. As the recipient is located, related recipient is located outside India, the value will be determined as per 28 sub Rule 1, that is open market value or LKK or cost plus 10% that should be taken. So 28 sub Rule 2 is not applicable here. Case 7, XYZ Limited issued a corporate guarantee of rupees 60 crores to its related party UVW Private Limited in India for a fixed term of 4 years starting on January 1, 2024. No actual consideration is charged for the guarantee. The guarantee is for a fixed term and XYZ Limited wants to understand the GST implication for the entire period of the guarantee. First, we need to compute the value as per Rule 28 sub Rule 2. That will be 60 crores into 1% into 4 years. there is no actual consideration, so 2 crore 40 lakhs, and GST payable under FCM for entire 2 crore 40 lakhs, GST payable on January 1st 2024 itself, because on the date on which they have given the guarantee, as it is a fixed term, on this date itself GST will be payable under RCM on Jan 1 2024 for entire 2 crore 40 lakhs, which means Jan 1 2024 will be taken as the time of supply for this transaction, and accordingly for Jan month they need to discharge the liability by 20th of February. That is the meaning of this. Then case 8, XYZ Limited issued a corporate guarantee of 12 crores to its related company TUV Limited in India for a 6-month period starting on April 1, only for a period of 6 months. No specific consideration is charged. XYZ Limited wants to know the value of the corporate guarantee and the GST payable for the short term guarantee. Simple, that is 12 crores into 1% into 6 by 12, that is 6 lakhs, and GST payable under FCM on April 1st 2024 for this 6 lakhs. Then case 9, XYZ Limited issued a corporate guarantee of 25 crores to its related entity BCD Limited for 1 year starting on June 1 with the option for annual renewals. No specific consideration is charged. What is the value and GST payable for first year and second year if renewed for second year? So every year we need to pay value under Rule 28 sub Rule 2 for first year. This is June 1 2024. So what is the amount? 25 crores into 1%, 25 lakhs. GST on above on the date of guarantee given. Then again value under Rule 28 sub Rule 2 for second year, that is June 1 2025. So as they have not given any component, that is 25 crores is for the first year, whether for the second year also 25 crores or not, they have not given. So we will take 25 crores itself for second year also into 1%, 25 lakhs. GST on above on the date of renewal will be taken. Then XYZ Limited, an Indian company, has issued a corporate guarantee of 75 crores to HDFC Bank on behalf of its related entity ABC Private Limited for a loan issued by HDFC Bank. After 3 years, ICICI Bank decided to take over the loan from HDFC Bank as a part of refinancing arrangement. During this process, XYZ Limited did not issue a new corporate guarantee but allowed the transfer of loan from HDFC Bank to ICICI. Does the takeover of loan from HDFC by ICICI result in any GS liability for XYZ Limited? No, as there is no fresh guarantee or renewal of guarantee by ICICI, GST liability shall not arise. If XYZ Limited issues a new corporate guarantee to ICICI for the remaining term of 2 years, calculate the GST payable on the new guarantee of rupees 75 lakhs. Then again GST liability will come. So value under Rule 28 sub Rule 2 75 lakhs into 1% into 2 years, GST payable on above on the date of execution of new corporate guarantee. Understood here? So covering all the points in circular, these are the possible questions that can be tested in exam. That's why I told you, because it's a very big amendment. So 2 questions I am expecting seriously for this attempt, that is one on appeals. In appeals they will be making 1 question, another on this corporate guarantee. Definitely chances are high. Then next, look into another one. So this circular already they have tested it for November 24 exam. I don't think so. Again it will be coming for May 25 exam. How to value internally generated services by head office to branch office. So head office will be incurring some expenses. These are not procured. These are not procured services. These are internally generated services, which means that the head office will be incurring the employee cost, or head office will incur the common expenses, etc. But they will be raising a debit note or raising an invoice to recover the money from its branch offices. So how to value that internally generated services? CBI circular on services provided by head office to branch office, not procured from a third party. First you need to see whether the branch office is eligible for full ITC. Generally head office and branch office are treated as distinct persons, and the value will be determined as per Rule 28. Usually when recipient is eligible for full ITC, then the value will be taken as transaction value. OMV equals to transaction value. Branch office eligible for full ITC, whether amount recovered or not by branch office, by head office, value under Rule 28 is invoice value. Value can be nil if invoice is not issued. If invoice is not at all issued, the value can be nil. That's what this point is actually common in many places. Whenever the recipient is eligible for full ITC, OMV equals to transaction value mentioned in the invoice. If invoice is not issued, the value can be taken as nil. So this already we saw in import of services, and another place also we are seeing this, that is head office to branch office. And if the branch office is not eligible for full ITC, generally when branch office is not eligible for full ITC, we need to determine the open market value. But they have given one special point here. If the amount is recovered from branch office by head office, then the open market value will be determined. If amount is not recovered, means invoice is not issued, the value will be taken as nil. So one line summary is that if invoice is not issued, the value will be nil. That is this CBSE circular, which means giving invoice is an optional. Like this, one more place where giving invoice is optional, that is in case of import of services where the GST is payable by the recipient under RCM. But what is common in these two? So that is recipient not eligible for full ITC, eligible for full ITC, eligible for full ITC. But in this circular, one more point, even if recipient not eligible for full ITC, if invoice is not issued, the value will be taken as nil. This is like an exception to rule 28. Above treatment is applicable even in case of import of service from a related person. That's the circular which we have already discussed about, this circular. How to determine the value of supply in case of import of service from a related person. Then now we are moving on to rule 31A. So 27, that is price is not sole consideration. 28, related party including distinct person. 29, principal agent transaction. 30, cost plus 10%. 31, residual value. 31A we are discussing, that is value of supply in case of lottery, betting, gambling and horse racing. In case of horse racing, betting and gambling, we need to take 100% of the face value of bet or amount paid into the totalizer. So both are same only. So if there is a face value of bet given, you take that. Otherwise, you see the total amount which is collected by the totalizer, not on the commission earned by the totalizer. For example, it's a horse race where 10 horses are participating in the race. People will randomly place bet on different horses. What is the total amount collected by the totalizer? That is the one who conduct the betting transaction will be taken as a value on which GST payable. And in all these cases, what is the rate of GST? 28% will be taken as the rate of GST. Whereas in case of lottery, therefore horse racing, what are the specified actionable claims? HC block. HC block is the specified actionable claim. What is H? Horse racing. C for casinos. B for betting. L for lottery. O for online money gaming. G for gambling. So therefore in case of horse racing, betting and gambling, they are telling this as the value. Whereas for the next one, lottery. In case of lottery, we need to see the price printed on the ticket or notified by the organizing state, whichever is higher. Say the price printed on the ticket is 500, but the price notified by the organizing state is 450, but we will take only 500 into 100 by 128. So there are two places where we need to assume that the value always inclusive of GST. That is number one, interest on account of delay in receipt of consideration. We need to assume that the value should be inclusive of GST. Again, in case of this lottery also, the value will be assumed as inclusive of GST, means the price of the ticket is assumed to be inclusive of GST. That's why into 100 by 128 is value. Then what is the value of supply in case of online money gaming and casinos? In case of online money gaming and casinos, so these both cases the treatment is similar, whereas in case of online money gaming, how much money we deposited for the purpose of playing the game. In online money gaming, what will happen? We will deposit an amount with the expectation of winning that amount, and here it may be a game of skill or game of chance or game of both, and whatever money initially we deposited, that should be taken as a value for payment of GST. After we play, we get a winnings. On that winnings, whether any GST is applicable? No. Initial deposit, whatever amount we have made, on that only GST payable. Suppose initially we made a deposit of 10,000 and we used 8,000 for playing the game. 2,000 rupees of the initial deposit, we thought it is not worth to play, so therefore we have withdrawn. Then in that case, will there be any reduction in liability? No. So initial deposit 10,000 means on the 10,000 GST will be payable. Is that clear? Say we played games and 10,000 rupees went to 18,000 rupees. Now on that extra 8,000 rupees we need to pay GST? No. If you use that 8,000 also in turn for playing, we don't have to pay any GST with respect to this. Suppose if that 18,000 you have withdrawn and again deposited, whether GST will be payable on that 18,000? Yes. every time you deposit, GST will be payable on the deposit. Valuation in case of specified actionable claim, supply of online gaming including online money gaming, the value of supply will be amount paid or payable or deposited with the supplier by way of money or money's worth, including virtual digital asset by or on behalf of the player. And in case of casinos, so whenever we go into casinos, we need to deposit money and we will buy the tokens or chips. So whatever money for which we purchase the tokens or chips, that will be taken as value for payment of GST. Amount paid or payable for purchase of token, chips, coins or tickets for use in casinos by or on behalf of player. In both these cases, if there is any amount returned or refunded by the supplier to the player, including amount paid or deposited with a supplier which is not used by the player, shall not be deductible from the value of supply. So it will not be deducted. Also, any winning amount which is used by a player without withdrawing shall not be considered as the amount paid or deposited with the supplier. Okay. So any amount that is withdrawn, there is no reduction, and suppose if using that he has played also, there is no GST with respect to that. That is with respect to this. Clear or not these 2 points? So first point, any amount returned or refunded, so there is no deduction, and any winning amount used by a player without withdrawing shall not be considered as amount paid or deposited. So that is about rule 31A, and related to this rule 31A, already one question they have tested it for May 25 exam, but there is a possibility of asking the same question again also, because it's a very good question. So they have given this in RTP, May 25 RTP, and it also came in exam also. So you can see that. Where is RTP? May 24. Say this question. Fortune 365 is an online money gaming platform operating from UAE. It provides its users with a platform to play and win money in different games that are available on its portal. In the month of December, player A, an unregistered person located in India, deposited an amount of 10,000 inclusive of GST. So the 10,000 will be chargeable to GST. That should be taken as the value. And what is the rate of GST? Always 28%. And it is specifically given as inclusive of GST. So we need to take. So 10,000 rupees into 28 divided by 128. That is 2,187.5 will be taken as the GST liability. So just make note somewhere, 2,187.5 will be taken as the liability. Subsequently, following transactions were undertaken by player A in the said month. Player A utilized the amount of 2,000 from the master wallet towards playing a virtual racing game. As a winning amount, 10,000 was credited to the master wallet of player A. No, there won't be any GST on this winning amount. On another portal, remember another portal, in the same portal if he is the playing, so there won't be any problem. But on the another portal operated by Fortune 365 in the name of bet 180, player A placed a bet of face value 11,000. Automatically it will come under betting transaction. So in case of betting transaction, now again we have another rule which says that the value of the bet should be taken for payment of GST. So bet face value 11,000 on international wrestling match. The amount of such bet was paid by the master wallet of player A. However, he lost the bet and hence the bet amount of 11,000 with applicable taxes, which means that 11,000 will be exclusive of GST. So again on 11,000 also there is GST, 11,000 into 28%, that is 3,080. Already you got some amount plus 3,080. What is the amount that you got? 2,000? 2,187.5, that is 5267.5. It should be rounded off to 5,268. That should be taken as the GST payable. And thereafter, player A transfer the balance amount from the master wallet to his bank account after the aforesaid transaction. Assume all above transaction to be exclusive of GST unless otherwise specified. Rate of GST applicable is 28% and ignore the bifurcation of GST amount into CGST. So question number 1, compute the total GST payable 5,267.5. You can see the answer here. So 5,268. Clear? 5,268. There is a second question. How much is the total amount transferred by player A to his bank account. First we deposited 10,000 and thereafter GST on deposit 2,188 is gone, and then we spent 2,000 rupees for playing the game, plus we got 10,000 as winning. So first 10,000 minus 2,188 minus 2,000 plus we got 10,000, and again we placed a bet of 11,000 and on the GST 3,080. So balance 1,732 will be refunded to that person. Okay, and there is a question. So like this can be tested, and because that particular attempt not many students have answered perfectly. And even one more point, if the online money gaming supplier is located outside India, who will pay GST? Whether the recipient in India will pay GST or the online money gaming supplier outside India only will pay GST. Online money gaming supplier outside India only will pay GST, and they are compulsorily required to get registered and they need to pay GST. Got it? Fine. So that is about this. We'll take a small break and then we will continue with the remaining portion here. Okay, we'll start. So there is one query, sir, in case of schedule 1 transaction as no consideration is involved, at what price it should be treated as supply and on what price tax should be calculated. So this question, even you might also have this doubt, that is, there are 7(1)(c) certain transactions, even though without consideration it constitutes supply. What are those transactions in section 7(1)(c)? That is 7(1)(c) read with schedule 1, read with schedule 1, that is DRIP, D-R-I-P, D for disposal of business asset on which ITC is availed. Now you check whether this particular business asset is capital goods or this will be other than capital goods. How you know whether it is capital goods or other than capital goods? We need to see whether this has been capitalized in the books or not capitalized in the books. If it is capitalized in the books, disposal of business asset on which ITC availed, and it is capital goods, we need to pay GST under section 18 subsection 6. GST under section 18 subsection 6, that is ITC availed minus 5% for every quarter or part thereof from the date of purchase till the date of sale, or GST on sale value, whichever is higher. There is no sale value, that's why only A will come, that is ITC availed minus 5% for every quarter or part thereof, etc. So here A will be ITC availed minus 5% for every quarter or part thereof will be taken, or B. So what is that B that we will take? B will be GST payable on sale value. As there is no sale value, we need to determine the value as per rule 30 or rule 31 and into GST rate should be taken. Again I am repeating, so carefully listen. First, disposal of business asset, that is 7(1)(c) read with schedule 1. In case of 7(1)(c) read with schedule 1, suppose if it is capital goods, what we need to do in case of capital goods? So we need to pay GST in terms of 18 subsection 6. Okay, GST under section 18 subsection 6. What does 18 subsection 6 says? We need to take A, that is ITC minus 5% into number of quarters. Okay, number of quarters are part thereof from when to when, from the date of purchase till the date of sale. B will be GST. GST on what value? That value will be determined under rule 30 or rule 31. So whichever is higher should be taken. This is in case of D point. Then suppose if it is others, other than capital goods. When it is other than capital goods, definitely 18(6) will not come. So GST will be payable under section 15, but we don't know the value. So what you need to do? We need to take GST on value under rule 30 or rule 31 should be taken in this case. Then R for related party transaction. In case of related party transaction, anyhow directly we have value under rule 28, that will be applicable. Thereafter, import of services from a related person or another establishment located outside India, that is again related person or distinct person only. So value under rule 28 will be taken. Thereafter, principal agent transaction. When it is principal agent transaction, we need to determine the value under rule 29. This is how. Suppose if 28 is not possible, then 30. If 30 is not possible, 31. Again here 28 not possible, 30. Then it will be 31. For 29 also 30. If not possible, 31. This is how we need to determine for 7(1)(c) read with schedule 1. Then, sir, whether recipient will need to pay interest on ITC reversal with respect to discount if there is no ITC balance on the electronic credit ledger with the ITC reversal is made? Of course, yes. So, when the recipient should reverse the ITC based on the credit note given by the supplier, if the credit note is given by the supplier in the January 2025, recipient should reverse the ITC for January 2025. If the recipient is not reversing for January 2025, but he reverses it for March 2025, then he need to pay the interest. Definitely he need to pay the interest because he need to reverse it by Jan. So why he need to reverse it by Jan when the credit note is given by supplier January month? So then the credit note, because of the credit note given by supplier, the January month liability will be reduced. So therefore the recipient should reverse the ITC for the month of January, but he is reversing for the month of March. So then definitely interest will be payable. But remember, interest will be computed only if the ITC is utilized. If they have maintained sufficient balance in ITC, so why will there be interest? Interest will not arise. If they have not maintained the sufficient balance in ITC, then only interest will arise. Okay. Then, so these are the two queries related to this. Then we are moving on to rule 34. Can the recipient claim ITC? Yes, definitely recipient can claim ITC. And where can I find this PDF? I want some, you can download it from my website, it is there. Next. No need to buy and all, yeah. So someone has replied, buy solved workbook of sir. No, it's already there in. I myself I am not telling to buy. Why you are telling to buy? Don't buy and all. It's already there. For the sake of that, don't buy. Already I gave that PDF in my downloads itself. Can the recipient claim this as ITC? Of course, they can definitely claim this as ITC. So, because whenever I am making disposal of business asset on which ITC avail, I am paying GST in terms of 18(6). Whatever GST I pay, I will raise invoice to the recipient. So, recipient can definitely take ITC. Now, coming back to this, rule 34. Relevant date for determination of exchange rate for the purpose of valuation and computation of GST. The relevant exchange rate in case of goods, we need to take always CBIC rate. In customs itself we discuss CBIC rate should be taken for goods. In case of services it will be GAAP rate. GAAP rate means average of the buying rate and the selling rate should be taken. Which date should be taken? The date of time of supply. First you need to determine the time of supply for the transaction. And on the date of time of supply, if it is goods, CBIC notified rate, if it is services, GAAP rate, and then you recognize the transaction which is denominated in foreign currency into Indian rupees, and on that GST will be payable. So in case of, when this will come into picture, usually in case of import of goods, import of services, export of goods, export of services, the invoices will be denominated in foreign currency, but we need to pay GST in Indian rupees. For the sake of this rule will be applicable. So goods rate notified by CBIC prevailing on the time of supply determined under section 12. In case of services, rate determined as per GAAP prevailing on the time of supply determined under section 13. And if there is any exchange gain or loss, for example, we recognize $1 as 85 rupees and we paid the GST, but actually on the date on which when we have actually received the money, 85 we recognize now, but 88 rupees we received. Now there is a 3 rupees gain. On that 3 rupees gain, whether we need to again pay GST? No. Ignore foreign exchange gain or loss. GAAP rate is average of the buying rate and selling rate. Then rule 32. Rule 32 is applicable in case of certain notified transactions where either I can follow transaction value or I can go for value as determined under this rule 32. So CGST rules value of supply in the special situations, either transaction value or value under this rule at the option of the supplier for each supply, each invoice they can decide. In that rule 32 sub rule 2 is applicable in case of foreign exchange transactions including money changing. Here again we have option 1 rule 32 2a and option 2 rule 32 2b. So first of all, in case of foreign exchange transactions, in case of forex transactions, either I can follow, so transaction value under section 15, I can follow, or I can follow value under rule 32 sub rule 2. Okay, so with respect to each invoice, this is with respect to each invoice, either I can follow transaction value under section 15 or value under rule 32 sub rule 2. Suppose if I am going for rule 32 sub rule 2, again there are two rules, that is rule 32 sub rule 2a, and rule 32 sub rule 2b. Two rules are there. Now what should I follow? That is with respect to each financial year. I need to follow either 32.2a or 32.2b. So therefore here I don't have with respect to each invoice, that with respect to each financial year, whereas transaction value under section 15 and value under rule 32 sub rule 2 with respect to each invoice. But this rule 32.2a, 32.2b I need to decide in the beginning of the financial year, and that only we need to follow. So which is for foreign exchange transactions including money changing. That's what I have given, option to be decided in the beginning of the financial year, which shall be applicable throughout the financial year. Okay, and what should be taken as the transaction value? Currency conversion fee or currency markup fee that is given in the question should be taken. And what is rule 32.2a value? Check whether one of the currency exchange involves Indian rupee and RBI reference rate is available for that currency. For example, we have $1 as rupees 85. This is the exchange rate, and RBI reference rate is $1 equals to rupees 86. Then what is the difference? 1. So that difference, 85 and 86, the difference is 1. That should be taken as a value. And if it is say for $10,000, 10,000 into 1, 10,000 rupees will be taken. Suppose if this is 88 means 85 and 88, there is a difference of 3. So 3 rupees into 10,000, so 30,000 should be taken as the value. So we need to take bid rate or ask rate depending upon the transaction, and minus RBI reference rate into units of currency. This is when one of the currency exchange involves Indian rupee and RBI reference rate is available for that currency on that day. When RBI reference rate is not available for the currency, what we need to do? The gross amount in Indian rupees. So coming back to this example, $1 is 85 and $10,000 is exchange. So 10,000 into 85 into 1% should be taken. That is the answer for this. Gross amount in 1% into 1%. When both the currencies exchange involves foreign currency, convert both the currencies into Indian rupees using RBI reference rate and multiply with 1%, whichever is lower. What if RBI reference rate is not available? Then you cannot do this. So this you can do only when RBI reference rate is available, otherwise we can't do this particular thing. Both the currencies, say for example dollars are exchanged into pounds, then in that case convert dollars as well as pounds into Indian rupees using RBI reference rate into 1%. What if RBI reference rate not available? Then this value cannot be determined as per this rule. So we need to go by transaction value only, that is currency conversion fee or markup fee only should be taken. Then rule 32.2b. Rule 32.2b is a slab rate model. In this slab rate model, we need to see first the gross amount in Indian rupees. If it is in the first slab up to 1 lakh, then 1% of the gross amount. So 3 slabs we have: up to 1 lakh, more than 1 lakh, up to 10 lakhs, more than 10 lakhs. First slab will be 1%, next slab will be 0.5%, thereafter next slab will be 0.1%. So first slab 1%, and there is a minimum value. That minimum value will be 250. For example, if it is 80,000 rupees, 80,000 into 1% will be 800, or 250, whichever is higher will be 800. And suppose if the value, like if the gross amount is somewhere like 15,000, 15,000 into 1% will be 150, or 250, whichever is higher will be 250. Suppose if the second slab I am going, so means first slab is 1 lakh, so 1 lakh into 1%, 1,000, 1,000 or 250, whichever is higher, 1,000. So the moment when I go to second slab, there will be a fixed amount of 1,000 plus for every amount beyond 1 lakh it will be 0.5%. Say for example 6 lakhs. For first 1 lakh it is 1,000, remaining 5 lakhs, 5 lakhs into 0.5%, that is 2,500, 2,500 plus 1,000, 3,500. Like that, if it is exactly 10 lakhs, For first 1 lakh it is 1000, next 9 lakhs, 9 lakhs into 0.5%, 4500. So 4500 plus 1000, 5500. When I go to the third slab, the fixed amount will be 5500 plus, for the amount exceeding 10 lakhs, it should be 0.1% and the maximum value will be 60,000. Say for example 500 lakhs. For first 10 lakhs it will be 5500, remaining 490 lakhs. 490 lakhs into 0.1%, that is 49,000. 49,000 plus 5500, that will be 54,500. So which is up to 60,000. So 54,500 only will be taken. If it goes beyond 60,000, then only the maximum 60,000 will be taken. What if the cross currency transaction is involved? Again, we cannot determine the value as per rule 32(2)(b), because here the gross amount is always in Indian rupees. If it is in foreign currency, you cannot determine. Then again you need to go by transaction value, that is currency conversion fee or markup fee. Then rule 32 sub rule 3, air travel agent services. Air travel agent, what will be taken as transaction value? Whatever is the commission that they are earning will be taken as a transaction value. If they go for rule 32, then we need to see what is the base fare in case of domestic bookings. Base fare into 5% in case of domestic bookings. In case of international bookings, 10% of base fare. That should be taken as value. Again, life insurance business. For life insurance business, if they go for transaction value, what should be taken? The premium collected will be taken as a transaction value. Suppose if they go for rule 32 sub rule 4, then we need to see first whether it is a risk cover policy. Risk cover policy means term insurance, means we will pay the insurance premium for a particular term. If nothing happens, so there won't be anything that they will be returning to us. If something happens, a sum assured will be given. That is called as risk cover policies. So as the entire premium collected by the insurance company is income to the insurance company, entire premium will be taken as a value. Whereas in case of single premium annuity policy, 10% of the single premium will be taken. For example, we will pay a single premium of 10 lakhs and that 10 lakhs they will reinvest and they will be generating a return. That return will be taken towards the premium payable by the person. Then 10 lakhs into 10%, that is 1 lakh will be taken as a value. Whereas in case of reinvestment policy means whatever premium that we pay will be invested into the equity market and they will be allotting the equity units, that is unit linked insurance plan like a mutual fund units, and whenever the equity value increases, the unit value also increases. So upon maturity or death, whichever is earlier, whatever is the NAV value of those units, we will be able to redeem that. But this particular unit linked insurance plan, entire premium may not be invested in the equity market. So premium collected minus amount allocated for investment, that difference will be taken as a value on which GST payable. Where amount is allocated for investment and it is intimated to the policyholder, gross premium minus amount allocated for investment. If the amount allocated for investment is not communicated to the policyholders, then it is treated as other policies. For other policies, what should be taken? 25% of premium in first year and 12.5% of premium in subsequent years. Then rule 32 sub rule 5. Rule 32 sub rule 5 is purchase and sale of second hand goods. In case of purchase and sale of second hand goods, so we need to take the value as the margin scheme. So sale price minus purchase price, that is called as margin scheme. And if they go for transaction value, what should be taken? The transaction value is nothing but the sale value, actual sale value should be taken. But if they go for margin scheme, for example, I am a second hand car dealer, I am buying a car for 1,50,000 and selling for 2,50,000. Suppose if I am not going for this rule, then I need to pay GST on 2,50,000. If I go for this rule, I need to pay GST on the difference, that is 2,50,000 minus 1,50,000. On 1 lakh only I need to pay GST. What if the value addition is negative? For example, I am purchasing for 1,50,000 but I am selling for 1,25,000. So then in that case, if I go for transaction value, I need to pay GST on 1,25,000. But if I go for a margin scheme, I don't have to pay GST at all, because as the margin is negative, no value will come. Okay, but very important condition is that ITC should not be availed on purchase. If ITC is availed on purchase, this point will not be applicable. Okay, means margin scheme is not applicable. Then even this margin scheme is applicable in two places. Point number 1, in case of repossession, the margin scheme is applicable. That will be original purchase price minus 5% for every quarter or part thereof from the date of purchase till the date of disposal of the repossessed asset. For example, I am a financier, I have given finance for an asset and that person has failed to pay the EMIs. When I am doing the repossession of that asset, I will sell this asset. definitely it's a used asset which I am selling, so therefore I can definitely go for margin scheme. Sale price is the price at which this asset repossessed is sold minus purchase price. What should be taken as purchase price? I need to construct the depreciated value. How will I construct the depreciated value? The original purchase price to the defaulting borrower minus 5% for every quarter or part thereof from the date of purchase till the date of disposal of the repossessed asset. I need to see the period and I need to reduce, so I will be able to determine the purchase price. So sale price minus purchase price, that will be taken as the margin on which GST payable. Again, what if this margin is negative? I will ignore, there won't be any GST that is payable. That is about this. In case of repossession, purchase price is original purchase price minus 5% for every quarter or part thereof from the date of purchase till the date of disposal of repossessed asset. Then also this is applied in one more place, that is notification 8 of 2018. I request you to kindly make note of this. Notification number 8 of 2018. In this notification 8 of 2018, so in study material somewhere in one corner they have given this notification 8 2018, which says that in case of sale of motor vehicles, but this notification 8 of 2018 is applicable only for motor vehicles, not applicable for other goods. In case of sale of motor vehicles, whether those motor vehicles are second hand or newly purchased motor vehicles, we are selling, means we are selling after usage, then value can be sale price minus depreciable value under section 32 of Income Tax Act. But here the depreciable value is not in terms of 5% etc. We need to go by regular depreciation as per section 32 for motor vehicles. What is that? 25%? 25 or 20% for motor vehicles. Some depreciation is there na, as per section 32. 15%, correct, sorry, 15%. So we need to reduce 15% for every year, and we need to determine what is the asset. And what if there are lot of motor vehicles in the block? Then you have to compute the depreciation as if this is the only motor vehicle in the block, and you need to ascertain the WDV as per section 32. So sale price minus depreciable value under section 32 of Income Tax Act. But again, so ITC should not be availed here, provided ITC is not availed on purchase. Okay, so this is in case of what? Only motor vehicles. In case of sale of motor vehicles, it's a newly purchased motor vehicle. Value can be sale price minus depreciable value under section 32 of Income Tax Act, provided ITC availed or not availed on purchase. ITC not availed on purchase. This is common in every pair in margin scheme. And what if the margin is negative? Value will be nil. So that is about this. Be careful. Maybe they will give one point in the question about sale of motor vehicles, and you need to apply this. Okay. Then next one, rule 32 sub rule 6, in case of coupon or vouchers. So what type of vouchers? Basically these are identifiable vouchers, and if it is sold the actual amount paid or payable for goods or services supplied against a voucher will be taken as transaction value. But rule 32 says don't take the actual price paid or payable for the goods, but instead you see the redeemable value of that voucher. So money value of supply is redeemable against that voucher or coupon. For example, I am giving you a Domino's voucher. When you are redeeming it, you will get one regular pizza. Then what is the price of that regular pizza? Say $2.99. The $2.99 will be taken as the redeemable value of this voucher. Then in case of notified services between distinct persons without consideration, nil if ITC is available on purchase, but this rule 32 sub rule 7 is not yet notified. What are those notified services? They have not yet notified, so therefore we don't have to remember this rule 32 sub rule 7. Then next one you can see below, TCS. Generally TCS under Income Tax Act should be included in the value under 15(2)(a) or not. As per 15(2)(a), all taxes, duties and cess by whatever name called other than GST should be included. Then logically TCS also should be included. But TCS is first of all not a tax. TCS under income tax is an interim levy. It is not a tax on income, it's a tax on expenditure. When someone is spending money, so he will be paying TCS. For example, you are buying a car from me, so you are paying me the TCS. That's not a tax on your income, that's a tax on your expenditure. It's an interim levy just to identify the source of income of that particular person. Due to that reason, it is not having the character of a tax. Due to that reason, you don't include it in the value. So TCS under Income Tax Act should not be included in the value. So under section 15 subsection 2 of CGST Act, any taxes duty shall be included in value of supply, but TCS is not included in the value because it is an interim levy, not having the character of tax. Okay, for example, I am selling a car to you for 15 lakhs and for which I am collecting 1% as TCS plus 28% GST. While computing this 28% GST, whether this 1% TCS to be included? No, it is not required to be included. Then next one, what is the value to be adopted for computing GST on service of business facilitator or business correspondent to a banking company? Business facilitators and business correspondents are agents of the banking company in order to extend the banking operations to many areas where the bank is not there. So they have appointed business facilitator and business business correspondent, and these facilitators and correspondents will be getting commission. That commission only should be taken as their value, but what they do is that sometimes they will be collecting the service charges from the customers and remitting the service charges. Even though they collect the service charges, but that is not retained by them, that will be given to the banking company. So that service charges will be included in the value of supply of banking company. Whatever commission they get, that only they need to pay GST on. And moreover, in this services provided by business correspondent, GST will be payable under FCM, whereas in case of business facilitator service to banking company, GST will be payable under RCM. So with this, we completed valuation under GST. That's one topic which many amendments are there, that's why I took that to be discussed.